Broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to this week's Nadex webinar, an introduction to knockouts and binary options and the new Nadex platform. We do these once a week. We've had in all these volatile markets a lot of new folks coming to our exchange and coming to our platform, and we find that these sessions have become tremendously helpful and useful to walk people through what are these products, what is this new cool platform, what is some of the functionality, and how can I leverage that functionality to make some trading decisions. I will say I do these every week, and we are using live market data, even though we're in a demo environment. So it does get kind of interesting and fun as we do that as well, because we'll actually be taking a look at what's going on in some of the markets as a byproduct. Anyhow, before I get going, I do have to take care of some housekeeping items before I really get going. The first up, I need to always put up the disclaimer per our compliance department, and that trading, it doesn't matter where it is, but even at Nadex, does involve risk, and that any trading you do is solely your responsibility, and the risk is yours. Now, more importantly, as I mentioned, we're going to see some live prices. I am going to be going through the platform. I probably am even going to do a demonstration trade, and we'll see what happens. But because I'm doing that, I don't want you to construe anything I say as a buy or sell recommendation. Very important. Nothing I say is a buy or sell recommendation. This is strictly for your educational purposes. So even though we're looking at live data and even though I'm going to be clicking around, please, just for education. Very important. Let's move into it. I like to put this up at the beginning as well. You can jot these down or take a screen capture. We are here to help you. If you have any questions at all about the markets, about our products, about our platform, about your account, we've got people that are always here to help. Give us a call. There's the phone number. Shoot us an email. You can shoot an email, customerservice@nadex.com. And I'm telling you right now, this session is definitely an interactive session. I've got my colleague Sophia in the background. She's awesome. She knows this stuff as well. So while I'm presenting, I'm actually not necessarily looking at the questions as we go, and engage with her. If like I did something too fast or you want some clarity, ask Sophia. She's there to help. In fact, she's one of the people on the back end when you call or email. We want to help you. If we can make you successful, we are successful. That's what we want. We want successful customers. We want people to have a good experience in our markets. So please, one of the ways that can happen is if you're having challenges, please reach out to us. In fact, I'm going to show you one other way to reach out to us quickly. And then I'm going to jump over to the platform in a second. But before I do, this is the order I like to do things in. I'm first going to go through what are knockouts, and go through some examples and show you, and we'll see them in the markets. I'm probably going to spend a little time on the Nadex charting tools then, and then I'll come back to binaries, and I'll probably do a little bit on call spreads as well. I mean, people ask about call spreads, but the bulk of our customers trade binary options and knockouts. We do have call spreads, and they're similar to knockouts, but they have some optionality. So I'll mention that as well. I want you to be aware of what we've got and all the markets that we've got these in. And I will tell you, when we get the binaries, I am going to focus, as I show you what they are and try to explain them, we're going to go through the fun ones, the 5-minute binaries, because I think if you watch an example of that, it's rather remarkable how quickly you pick up the price action that can happen in binaries and how those prices move. It's great to see it real time. Okay, so now I am going to switch my screen. Give me 1 second here, because I want to bring up the platform. And by the way, I just want to mention, if anyone is having technical difficulties, if you're not hearing me or you're because we are delivering this over the internet isn't always wholly reliable. If you're having challenges, please refresh your browser. If you refresh your browser, that'll often solve the problem. If that doesn't, you may have to sign out and sign back in. Unfortunately, do note that I am recording this, so this will be made available. You'll be able to play the recording back at your leisure. But I should probably always put that up front just in case, because that can happen. Let's switch now to this. Okay. You know what? I mentioned the recordings. I'm going to do this too. I want to mention to you, we do have a YouTube channel. I would highly recommend that you subscribe to it. In fact, we did a virtual education summit. It was a 2-day full-blown summit. We just did it a couple of weeks ago. You can see that right here. There's 8 one-hour sessions. We did a basic day and an advanced day. Go watch it at your leisure. I mean, you can see if I click on that, you'll see all the different topics that we had. In fact, I'm going to chat out a link for this, but all of our I'll be posting this video up here as well. So this is where you'll actually find the recordings. And but I did want to mention, go to YouTube, Nadex, and in fact, I'm going to try to do this right now. I'm going to try to chat this out to everybody. Yeah, there. You might want to just copy that. That's a bit.ly link. I don't know if it's clickable, but if you copy it, you can paste it in, and it'll take you right to to our YouTube channel. So that is one way for you to find the content that we do. The other way that you find content is it'll be under the webinar section. In fact, I would recommend you take a peek. We have all of our upcoming webinars as well as all of our on-demand, and you'll find the on-demand webinars here as well. And then if you pay attention, we're going to be having a new website pretty soon. A much cooler, cleaner, sleeker experience that I think you'll like. So stay tuned for that. One other thing I would like to mention is this chat function down here in the bottom right-hand corner. I mentioned that you can email us, you can call us, you can also chat with us. We are here to help. Okay, now I am going to log into the platform. Up here in the right-hand corner, when I click login, it will bring up the platform. Now, this is also going to change. Right now, if you logged in, you would go to it's our current platform, but I'm going to call it our old platform. We are soon going to be putting everyone into the new, improved experience. It's currently called beta. It's not really beta anymore. In fact, the functionality has caught up to the old platform, and in fact, it's exceeded it, particularly in things like charts. Our charts are much better. So I would actually recommend that you click join the beta and just use that when you log into your account. Now, I mentioned that I'm going to be doing this in a demo environment. Notice in the upper right-hand corner, I am in a demo. If you don't have a demo account, you can sign up for one for free, and you can practice. The demo environment replicates our live environment. It's just demo markets. So it's paper money. It's not real trading, and your experience in a demo environment will not exactly replicate live markets, particularly if you're going to trade in between. If you want, and I'll explain bid-ask spread, and if you want to put an order in between, you do that in a demo environment, you may or may not get traded with. A live environment, actually, you might have a higher probability of getting traded with because someone else is looking at it and might be interested. And all the prices don't always work exactly right. I mean, the live environment is live. It then gets fed into another environment for demo. So it's not exactly the same, but it's close. It is very close, and it's a great way for you to practice where to click, how to get comfortable with the charts, how to set up your charts, maybe do some practice trades and see what happens. We highly encourage people to do a demo before they get into live. We find people that do demo first tend to have a higher probability of success just because they're more comfortable with everything that they're doing. So I really want to emphasize that, but this is a demo environment. If it was live, it would say live up here. Okay, now when you open up the platform for the first time, in fact, I'm going to do this too to make it a little bit bigger so you guys can see a little bit better. Hopefully that um, gives a little more screen real estate. You notice that it's broken into three sections. We've got our products and markets over here on the left. You'll have your positions and orders and history down here at the bottom. And then your workspace is where the charts and the order ticket are going to show up. Since I haven't clicked on anything yet, it's currently empty. Um, I told you I'm going to start off with knockouts, but up here at top, we have binary options, call spreads, and knockouts. And we are going to talk a bit about each one of them. And in each one, there are different products, indices, foreign exchange, some of our more popular products, event contracts around economic announcements from the U.S. government, commodities, and then we even have some shorter term contracts. I mean, in these, when we look at them, you'll see we have hourly contracts, daily contracts, weekly contracts, but then we've got some very short minute, 5 minutes, and we're going to get into that in the binaries, 20 minutes in indexes, uh, call spreads. Here's the markets we've got available. I'm going to jump over to knockouts. Knockouts are always weekly contracts, and there's a reason for that. We don't need a daily contract or hourly contract for knockouts because the way they work, you are simply trading the price of the underlying asset with some boundaries on it. The fact that it goes out a week is kind of nice to give it some time, but often because of the way the boundaries are set, one of them will probably get touched during the course of the week and we'll list new products. So we are on knockouts, and I am going to actually just go ahead and click on indices, and you can see that we've got 4 indexes in our knockout markets: the S&P 500, the US 500, the Russell 2000, which is the small cap stocks, Nasdaq, which is the Tech 100, and the Dow Jones. Okay. And again, I want to encourage you as I'm going, if you have any questions, want any clarity, type in some questions to Sophia. She's back there paying attention. I am going to go ahead and just have some fun with the S&P 500 for this session. Notice when I click on it, there are always 4 knockouts for each. And in fact, if I open the other ones up, you'll notice there's always 4 knockouts. Now, what are knockouts? I'm going to go ahead and just click on one of them so I can populate the chart and the workspace. I am now going to get this out of the way. Notice there's little hide buttons down here. And I'm actually going to go ahead and get rid of this right now. I'll probably bring it back up if we put an order in or when we put an order in, but I'm going to go ahead and shrink that down because I want the screen real estate this so that you can see. And let's make it so it's, there we go. Okay. Now, I am doing this on one screen. Something I'd like to point out that's been a high priority for our customers. Notice this tear off chart. I can tear this chart off and I would have a separate window with just this chart. I could even do the same with my order ticket. A lot of people have multiple screens, so they're not doing it just from one screen. They might have 2 screens or 3 screens in front of them. This is a way for you to have a chart and an order ticket, and if you wanted to watch 4 markets at the same time, you could have 4 charts, 4 order tickets. You could even have the one then in the platform, so you can have a 5th one. And if you saw something happening, you can quickly and easily place an order or do a trade in one of the other markets, so you don't have to keep switching around and changing. You can set everything up as you like and see it all at once. This tear off functionality was very popular. We've got it working. Now, what are we looking at for knockouts? A knockout, when you trade a knockout, you are trading the actual underlying price of the product. Here, we are looking at the S&P 500, the US 500. Notice it tells me up here, it tells me over here, and I get an indicative price of where that is currently trading. It's trading at 30.95, 30, right here at 30.95 and change. Okay. You also see it here on the chart. Now, what are the prices that we're looking at when you can buy or sell, right? So there's a bid. This is the highest price someone's willing to pay. There's the ask. That's the lowest price someone's willing to sell. And that bid ask spread, if you notice, it goes right around the indicative price. So you are trading. When you trade and knockouts, you're trading the price of the underlying. Do I think this is going to go up, or do I think it's going to go down? It's very intuitive, just like you would trade any other product. And the bid ask spread around that is going to be right around the indicative price. It's kind of, now, if I want to do a trade, I don't have to trade on one of these markets. I could choose to trade between. So let's say I thought this was going to go, and let's just have fun, lower. And again, not a buy, sell, or hold recommendation. If I wanted to sell one, okay, and maybe I don't want to do it in this contract. Maybe I want to, you know what, I'm going to choose a different one for a reason. Okay, and I'm going to explain that in a second. But if I wanted to sell one of these, and I wanted to put an order between the markets, so let's go 30.94. Let's just put 30.94 in there. Okay, and I'm going to go ahead and I'm going to, it's a little above the market. There's my order. I placed it. And it tells me it received my order. I just placed one to sell. And in fact, if I go down here in my orders, you can see, oh, it traded. It went from orders to positions. I sold one at 30.94. Now, what did I just do? All right, again, not a buy, sell, or hold recommendation. I just wanted to show you. Now, I sold one at 30.94, and it tells me exactly what I did. With a knockout, there is a floor and a ceiling for every contract. Okay, and it tells you very clearly on the chart. The floor on this one is 30.60. The ceiling is 31.10. Okay, and if we look up here, it also tells me in the order ticket. Now, we also know that this contract will expire in 1 day and 3 hours. It tells me on my order ticket as well. Tomorrow afternoon, this order will expire, or this product will expire. Now, what happens here? What did I do? I just, as a speculation, thought that this is going to go lower, so I sold one at 30.94. If I am wrong and the price of the S&P 500 goes up to 31.10 and touches it, I will get knocked out of the trade. That's why it's called a knockout. Now, when I entered this, I knew at the beginning, if 31.10 is actually touched, I sold one of these, I could potentially lose $160. That is my maximum loss. I can't lose more than $160. I sold it, I was wrong, and it went higher. Now, on the flip side, my speculation that it was going to continue to go lower if the S&P 500 trades down and touches 30.60. I would get knocked out of the trade for a profit. And there, if 30.60 is touched, I could potentially make $340. So when I do a knockout, and if you notice, in the S&P 500, in fact, in all of our products except the Nasdaq, the spread is always going to be between the floor and the ceiling, $500, which means the total on the contract, my potential profit and my potential loss, if you add them together, it adds up to $500. Now, when I sold that, someone on the other side had to buy it. They thought it was going higher, and they're the exact opposite. If someone had bought one for 30.94, or if I had bought one for 30.94, let's just do that. Notice that the risk reward is exactly opposite. If I bought one at 30.94 and it went up to 31.10, okay, yay, I was right, it went higher, I bought it, I would make $160. But if it drops, I potentially could lose $340 if it touches 30.60. Now I sold, so I definitely want to keep it on the sold side because that's what I actually did. So let's stick with my actual example. What happens if it doesn't touch either one of these boundaries in the next 1 day and 3 hours? What'll happen is I will experience a partial loss or a partial gain based on where the product settles. So in 1 day and 3 hours, if it settles somewhere in this range between 31.10 and 30.60 and doesn't ever touch one of these, it will settle to a price. And if I sold at 30.94, if it settles higher than 30.94, I'll have a partial loss. If it settles lower than 30.94, I'll have a partial profit. And so when you trade knockouts, you are trading the price of the underlying with boundaries around it where you have a profit goal or a stop loss. I didn't want to risk any more than 160. That is why I chose this particular knockout, is I wanted to give myself more downside, potential profit because I sold, and I wanted to risk less, so I wanted to bring my ceiling in a little bit. Notice on our charts that we put the knockouts on the chart for you in these blue lines on the left. So you can quickly and easily identify which knockout range has the proper risk reward profile that you're looking for. Since I was selling, this is the one that I chose because if I'm wrong and it rallies up, I just want to be out. I mean, this thing could take off. Now, if it touches, it looks like earlier this week it did touch, right? I'm on a 5-minute chart here and I'm looking. Oh no, you know what? I take it back. That's not this week. That was earlier today. It did touch. So for example, had I sold this product earlier in the day, all right, and it went sideways, 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 rallied up, I'm still in my short contract here. But then right here, I would have been knocked out for a loss. I'd have been out of the trade. It did continue and it went higher, higher, and then came back down below. All right. That is how a knockout works, though. You are protected. If this thing had kept going higher, I could not have lost any more. But it did get knocked out here. And now here we are. I'm back in the trade. I mean, if I had sold it in here, it rallied up. I'm still in the trade. It never touched here. It's come down some. Looks like it's rallying a little bit here. But again, I made a prediction. My prediction was it was going to go lower, and I wanted to limit my losses if I'm wrong and it went up. Gave myself some room to the downside if I was correct to try to make some more profits. Now, if I wanted to go the other way, let's say you wanted to buy one, this is why I like these, the nice clear lines on the chart here. All right, if I wanted to buy one of these, maybe this is the one I would want, or even potentially this one. I'm kind of playing with fire here a little bit. But let's say you thought this was going up, and I wanted to buy it at 30.98, which is where we are. So let's go ahead and put 30.98 in here. All right, if I bought one here at 30.98 because I thought it was going higher, notice that I can only lose $80 because my floor is 30.90. I mean, we're just above the floor. This could come down here, touch it, I could get knocked out and it can go higher. That's the risk of trading something so close to the floor, but it does keep my potential losses tight and limited. And it gives me plenty of room to the upside if I'm right. If it does rally from here, I could potentially make $420. I'm only risking 80 if it went all the way up here. Now, the cool thing about knockouts, just because you have this floor and ceiling does not mean I need to wait for it to touch one of those or for it to expire. Let's go back to my example where I sold one, okay? So let's just kind of talk about this. And I sold one at 30.94. So let's put that price back in because I was wrong. All right, it's ticked higher. I could potentially lose $160, but all right, I want to qualify this. If it keeps going higher and I decide, you know what, I'm wrong, I want to get out, I do not have to wait for it to go up to 31.10 and knock me out. It can go up to 31 even 3,100. All right, and I could say, you know what, I want to buy it back, and I could just experience a partial loss. I don't have to wait. That's a decision that you would need to make. On the flip side, if it were to start coming down, I don't have to wait for it to come all the way down to 30.60 in order for me to recognize maximum profit. It could come down to 30.90. All right, 30.80. Let's say it just comes down to 30.80, right? Because I sold it at 30.94. Let's say it comes down to 30.80. Okay, I could just take my $140 profit, right? In fact, I could right now just say, all right, I sold it at 30.94. I know I would get knocked out at 31.10, but I want to buy it back at 30.80. If it comes down there, because I might not be paying attention, I can place an order below the market. All right. And I just put a 30.80 bid in. So if somehow it were to come down to this level to 30.80, I would take take my short position off and for a profit. And in fact, if you notice, here's my short position that I sold at 30.94, and I did put just a limit order below. I would take it off down at 30.80. Okay, if it were to trade down. Now, if it keeps trading up and hits 31.10, I would be knocked out. I would then probably want to cancel this so that I don't end up buying one down at 30.80 as well. So you do have to pay a little bit of attention on something like that. But if I didn't put any bid below and it were to trade lower, I would be knocked out down at 30.60. Now, this is where I want to do a little bit on charts because I find it kind of really it's a perfect place to put it in. We've got some very robust charting functionality. I am going to look up at indicators. I believe we have 27 of these different indicators that you can populate the chart with. If you're not familiar with what all of these indicators are, we do have an information button that gives you some basic information. And if you would like some further information, I would recommend Daily FX, our sister company. It's part of the IG group. DailyFX.com. They've got a lot of education on indicators, technical analysis, very handy, useful information to help you along on your journey. I am going to pick one of these just for fun. Let's go ahead and pick Bollinger Bands, which, if you weren't sure what they were, it uses moving averages, so it's baked into the Bollinger Bands, and standard deviations. So there's math around it to give you some ideas of where you might see support and resistance on a product or where you might see breakout points. When I click Bollinger Bands, notice how it populates Bollinger Bands. Oops, I didn't want to take away that. I would like to leave this up here just for perspective. It does put some Bollinger Bands, and you actually saw that it, up here that did act as some resistance. Down here it did act as some support. You see that moving average running right through the middle. Now, if you're not familiar with moving averages, I'll just give you a little plug on moving averages. The theory is mean reversion. What does that mean? Mean reversion just means mean is the average. Again, math. The idea is that a price might get below its moving average and will want to have a tendency to move back to the moving average, revert to the mean. It might get above a moving average, but it'll eventually want to revert back to the mean. So it just sort of gives you some idea of where you might want to look for entry or exit points or support and resistance levels. If you wanted to change the settings in your Bollinger Bands, notice here on my chart, I could simply click this, and I'm using a 20 period and we're using 5-minute charts. Maybe you want to use more periods and apply that, and it's going to change the range that you're going to see. Right? And maybe I don't want to do 2 standard deviations. Maybe I only want to do 1 standard deviation. You can customize it how you see fit. You can even change how it displays on our charts. So again, I just wanted to do a little bit that you can use charts and I'm gonna go ahead and turn Bollinger Bands off to set up places where you might identify potential support, resistance, or entry or exit levels. The other thing that we have are drawings, all right? And I'm going to show you, we've got lots of drawings. Right now, let's just kind of do a little trend line. It has been trending lower today. If I start here from earlier in the day and just do a trend line through, I'm just kind of force fitting this. Oops, I wanted to click on the chart again. Notice how I just kind of picked the high point here over here on the left and a low point here where things have been kind of settling out. We are seeing a little, it's actually been more of a sideways trend. Maybe that trend line doesn't really help. Maybe if I do drawings, I can actually probably better off with the horizontal line, and I can kind of look to see. The crazy thing is this 3110 level seems to be a pretty interesting level. It definitely acted as resistance earlier in the day, definitely acted as resistance here. I don't know what's going to happen. Where's another level? I'm just kind of fitting this to the chart. I just kind of put a line here right around 3094, which is actually where I traded, where it's sort of been trading through that range. We've kind of gone sideways through 3094 all day long. So maybe this has been an opportunity for, when it's been above here to sell it, and when it's dipped below to buy. Again, I'm just playing around with charts. You would have to do the analysis on your own. I'm going to remove all drawings because I do always like to put up one drawing because it tends to be a popular one, which is Fibonacci. All right, I'm going to do Fibonacci retracement. If you're not familiar with Fibonacci, actually, you know what else? I'm going to remove that. I'm going to make my chart a little bit bigger. I'm going to drag this out and make it a little longer. Let's take a little bit longer view of what's been going on here in the S&P 500. So this is actually, if you notice down here, you can tell where I am on the chart. I'm actually going to look at the last couple days. Let's take a look at what, since Wednesday, okay? Let's take a look at what the S&P 500 has done. And with Fibonacci, all right, and I'm on a 5-minute chart, I'm going to go ahead and grab this. I'm going to go Fibonacci retracement, and I'm going to click in the upper left-hand corner because it's clearly been a downtrend. And I click once, and then I'm going to draw down to sort of fit where it's there. I mean, you kind of see it. And then I clicked in the bottom right-hand corner. You could see how it's acted as resistance all the way down. This has been the trend here. It acted as a bit of a support, resistance. I mean, this is the trend we're seeing for the last 2 days. And I just started in the upper left-hand corner and went to the bottom right-hand corner. I could have drawn this a little differently if I wanted to. I might have been able to pull this down a little bit further. If I were doing an uptrend with Fibonacci, I would start in the lower left-hand corner and go to the upper right-hand corner. Now, what Fibonacci, it's a mathematical calculation. Let's fit this a little bit better there so we can definitely see. Let's shrink this down. Okay, I want to so you can see it. What Fibonacci does, it's a mathematical calculation based on ratios that are seen in nature. We see this in plants. It's the golden ratio. We see it in architecture. We see it in the human body. People think that you might see it in the markets with these ratios where you might see support and resistance levels that are mathematically related. And those are those gray lines that I'm making the Fibonacci because I'm sitting on it for you to be able to see, has it worked? And to a certain degree, when we started in the upper left-hand corner, it certainly started to act as some support here, but when it broke through that level, it actually broke down. It rallied back up, but then it broke down. This level here, the 3114 level, acted as support, and then it acted as resistance. You can see how it kept on resisting here. Then it broke through, and it sort of became a support level. But we are definitely in a downtrend. Let's take a look at where we are on our charts over here to the right. And for sure, look, this level right here, this 3107 level has been resistance. And we can see how it's hit resistance, then it broke through and it was support for a little bit. And that's the way support and resistance work. When it breaks through, it then becomes, look at this little channel here. There was a trade here where it bounced between these two levels. When it broke through, it came way down, and then it eventually rallied back up, and this became the resistance again. And now it's trying to play around with this 3097 level. And we can see that that's kind of an important level. Is that going to continue to be support, or is it going to break through and are we going to see it come to the downside? Again, trading decisions that you have to make, but I just wanted to show you how you can use Fibonacci on our charts. Our charts, we've got some great functionality on these charts, and it's really nice on the knockouts for you to be able to see that functionality and then potentially choose which knockout contract suits what you're looking to do or how you might want to make a trading decision based on the risk reward profile. So that is knockouts and quite a bit on charts. I did show you how you can place some orders between the markets, how you can place, bids or offers away from the market. What I'd like to do now is, before I go to binaries, I just want to point out call spreads. And I'm going to bring up the S&P 500, and I'm going to, here it's a daily contract. And what you see on call spreads, and I'm just going to pick one again. Okay, and I'm going to go ahead and hide it. With a call spread, you are trading a range just like with knockouts. The difference here, though, is if the floor or the ceiling is touched, you are not knocked out of the trade. It's just you're picking a range, and so if I sold this particular contract, the and now and this is a $400 contract. Let's just go 30. Let's just go 3097. So it's a nice round number, right? And we actually knew that that was if I sold one of these, the maximum I could lose, all right, is 130, and that's it uh, if it settles above 3110. Okay, at the end of the day, this is a daily contract. If at the end of the day it settles above 3110, anywhere up here, I can't lose more than 130. If it settles down at 3070 or below, I stand to make $270. Okay, but notice the price. The indicative price of the contract is 3097, and the actual prices that you're trading are a little different, and that is because there is a premium involved with that optionality. You're going to give up some of your opportunity. You're going to sell for a little less, or you're going to buy for a little more, um, around the probabilities of where this contract actually might settle. So you don't get knocked out of the trade if you're wrong. You know your losses are limited or your gains are limited. So it's totally defined risk reward, but you're going to pay a little bit of a premium so that if it were to touch the edge and then go back your way, you're not knocked out. You have optionality associated with it. It gives you more time to be right, but it's going to cost you more in order to have that. Um, some people like the knockouts just because it's very clean and easy and there's no slippage. It really is defined risk, defined reward. I know exactly what I'm getting into. These actually have some decay associated with them. Um, throughout the day, so act a little bit more like your traditional options. But I just wanted to kind of put a plug in there for call spreads, similar to knockouts. It's just they have optionality, a little bit more complicated, and there is a premium involved. Now let's get over to binary options. All right, and binary options, and let's just pick, and here I'm going to, let's pick a commodity. Let's take a look at crude oil today. Let's just see. Is there something that's more at the money? Because it works. Let's take a look at gold. All right, this will actually work. All right. Notice when I click on one of these products that there are a bunch of different strike prices available. Okay, and the prices that you see are different than the other products. I just clicked on this one where the price you see 35 and a quarter to 41 and a quarter. When I click on that, I am now going to shrink this aside. And what am I looking at? I am looking at a chart of gold. This expires in 1 day. Okay. The current indicative price of gold is 17, right around here at 1730, 1729, 63. Now, a binary contract is what is the probability that this product, gold, will be higher, will settle higher than the strike price, 1733.50. So in tomorrow at 1:30 in the afternoon, will gold be higher than 1733.50? If it is higher than 1733.50, this product will be worth $100. If it's not higher than 1733.50, it will be worth zero. So these are the probabilities that this statement will be true. If I think gold is going to go higher, I can buy. Maybe I can, here, I'm going to go ahead and put 38 right in the middle. Okay, and let's go ahead and place my order. Oh, I put 39. Let's put 38, which is right in the middle here. And I'm going to place my order. And it's got my order in there. Now, I'm paying a 30, there's my 38, my bid. I'm going to pay $38 because I think gold's going to settle higher than 1733.50. I can only lose $38. If it does not settle higher than 1733.50, this goes to zero and I lose my $38. However, if it settles higher in this blue zone, okay, it goes to 100 and I would make $62. All right, so I'm risking 38 to make 62. That's what a binary option is, either 0 or 100. Notice the higher the prices are, the lower the probability. Up here, the market is only, for 1743.50, the market is only saying maybe there's an 18% chance to go up here. I could risk 18 to potentially make 72 because it's got to be a total of 100, but that's a pretty low probability trade. Down here, they're almost pricing this as a guaranteed lock. This is 93, 93% probability that it's going to settle above 13.50. So, here, not, if I bought one for 93, I'm risking $93, so I could lose 93 to make 7. Is that worth it? Maybe statistically or probability wise, it might be worth it if you just want to try to make $7, but you're risking 93. I don't know if the risk reward is necessarily there for you. But the important point here, just like with knockouts or with call spreads, just because there's an expiration associated with it doesn't mean I have to wait till expiration. If I bought this for, I bid 38 for it. If I bought one for 38 and it actually went to 1733.50, so this thing rallied for $4, gold rallies $4, this would be right at the money. This would probably be trading at a 50 probability, 50-50. The price for this would be right around 50, would be probably 48.52, because I don't know if it's going to go up or down if it's right at 1733.5, at which point I could sell my 38, maybe sell it for $50 and make $12. I would have risked 38 but made a $12 just because I was right that the product went higher. So just because of this, an expiration doesn't mean you have to wait till expiration. If anyone's confused on that, type questions into Sophia, but that is binary options. Now, what I would like to do as we wrap up the session is I want to show you that price action on binary options. We are going to go to a 5-minute, and these are all foreign exchange. So let's, I like, everyone's familiar with the euro, US dollar, so I'm going to click on euro US dollar, and I'm just going to click on one of the prices here. Get rid of this. Notice this contract expires in 1 minute and 37 seconds. You know what? We're probably not going to have enough time for me to set this chart up because I want you to see all of, wow, the euro just sold off. You know what? We're going to do this right. Let's fix our time frame. Let's make this shorter. I apologize. Whoops, we slid the whole thing. I didn't want to do that. Let's set the time frame to a day. There, that's a little bit better. Let's make this a 1 minute chart. We can actually make it a 1 second chart if we wanted to. I'm just making this so we can see what's there we go. Much better. Okay. Now, if you can follow, the euro the euro US dollar just slipped, in the last few minutes here. But when we look, here's the indicative price right now. This contract expires in 34 seconds. These products are all going to go to 0 in a second. We're 112. We're above this 112.01. Look at, yeah, let's just wait. This has got 22 seconds. This is what happens when you go into the last few seconds of a product. Because there's so much volatility, this is either going to be 0 or 100. This is going to be 0 or 100. And it can change in such a blink that those last 20 seconds, there really aren't any prices. I mean, look at this. This 3 seconds, 2 seconds, 1, done. Okay. The 112.03 settled at 0. It went to 0. The 112.01 went to 100. Here we go again. We just started another horse race. This is a 5-minute binary, and these are the probabilities that it is going to finish. Let's click on one. Look at this. The 112.01, which just settled at 100, is at the money. There's a 50-50 probability that this is going to finish higher than this because this is right where the price is. If the euro continues to tick lower, which it apparently is doing, as it goes down through here, these probabilities are going to trade below 50. And notice how this one, where there was a 75, if this continues to go lower, as it's doing right now, the probability on this is going to continue to go lower. And if it comes all the way down here, this is going to go from 75 or all the way down to 50. I don't know where this is going to go. Oil is ticking pretty quickly. Let's do a 1 second. Oh, there's not. Let's just keep it at 1 minute because I'm not going to be able to see it all. And let's just bring this back in so we could see all of them. I just want to watch this. We've got 3 minutes and 42 seconds. If you want price action, this is price action. This 112.01 was just trading in the 40s. It's now trading up near 60 because the euro is ticking higher, and the probability that's going to stay above 112.01 is becoming more and more likely. Look at it as it rallies back. Wow, this one, which was in the 70s, is now near 100 or up in the upper 90s. This one, which is in the 40s, is now trading up in the 70s. This one, which had a low probability, it was 20, is now becoming at the money. It's getting closer and closer to 50. So this is where people like, if you want price action, if you're looking for things zooming around, 5-minute binaries, very popular. They're all in foreign exchange, and you're trading the probability that this statement, will the euro US dollar finish higher than that level in 2 minutes and 45 seconds. So if you're looking for some quick short-term price action, these 5-minute binaries, these probabilities, and they're always limited risk, limited reward. The most the contract can ever be worth is 100. The lowest it can ever be worth is 0, and it will trade as a probability between 0 and 100 that statement is going to be true. And you'll see these probabilities as you get closer and closer to the actual settlement price, as the price of the underlying moves around. We got 2 minutes and 10 seconds left in this horse race. Where is it going to be? If it stays below 112, maybe I think it's going to stay below 112, and I just want to I'm going to sell one. 35. Oh, let's just sell one. I just sold one at, all right. So let's just take a look what I did, because I do have a position now. I sold one at 41. That was the price that I got. Wow, I was wrong. Now I know when I sold it at 41, I couldn't lose any more than $59. This could go to 100. I sold it at 41. I might lose $59 here because I sold it and it kept going higher. If I'm not comfortable and I think, oops, I made a mistake, there's only 1 minute and 24 seconds and I want to buy it back, I could buy it back for a partial loss, or I can wait and see if it comes back down. Again, because I sold it, I need it to settle below this level. It's continuing to go higher. All right, if I don't like this anymore, I just buy it back. Oop, and you know what? Did I buy it back? I did. I bought it back for 90 something. In fact, if we want to look at my history, I actually bought it. I did take it off. I was wrong. I didn't want to experience the full loss, so I saved myself $10 extra because it looks like it is with 44 seconds. It looks like it's not going to come back down between 112.03. All right. So again, just because there's an expiration associated with it doesn't mean I have to take the whole loss. I didn't take the whole loss. I actually saved myself $10. I didn't have to take the full $60 loss. I only lost 50. I was wrong. All right. It went higher. And there we go, 17 seconds left, and notice how the prices all disappear. That is binary options. Now, the reason I wanted to show you those 5 minutes is because that's you can really get if you watch and follow and practice, you can see how the price of these probabilities move around, particularly as it gets closer to expiration. You don't have to trade something that's that volatile. You can choose these hourly products or daily or weekly. The probabilities will move around, but you can always say, hey, if I think it's going higher, buy a probability, and if it does, you can always sell out of it and take a partial profit. If it's going against you and you decide you're wrong, you can always sell it for a partial loss, or you can wait and see how things go, knowing though, in the end, as you get closer and closer to settlement, and you saw what happens in that last 5 minutes, the volatility and the probabilities between these products can move quickly and dramatically, because every one of these either goes to 0 or 100. and that's it. It's 100 or 0 in the end. That's why it's called a binary. With that, I did go a little longer than I had anticipated. Hopefully you've been engaging with Sophia in the background and asking her questions. And I do want to remind you that we are here to help. In fact, if I can do this again, here we go. There we go. Reach out to us on chat on our website. Call us, shoot us an email, join us for more of these sessions. And in that chat, I did, that bit.ly link I put out. Go check out our Nadex YouTube channel. All of these recordings are there. You go back, particularly if you missed our virtual education summit. We're going to be doing another one. I think we're going to do a little bit bigger, maybe even do 3 days, sometime this summer. So stay tuned for that. And I want to thank you again for joining us and wish you all good luck in the markets.